the consistent view is that this is rather inflationary. And so if we have a consistent view between the asset classes, which helped, right, I think then you come to the conclusion we said, okay, it's rather 450, maybe it can go up to 5 on the 10-year treasuries. Yeah. And that's the risk we need to watch then. So because, as I said, the equity market might not do so well the closer we get to the 5. And okay. I think, so if I may, because the emotional discussion was we have to look at 10-year break-even inflations as well. And you see them going to 2.5. That's also a trigger point for the market. And there you get the inflation, and I think that's important.
All right, so both sides across the Atlantic, yourselves and your U.S. colleagues, agree that, look, Trump is likely to be inflationary. We could see yields go up to 5%, which would become a problem. I think we're both agreed for equities, right? Was there consensus in terms of central bank response? I'm talking here about the Fed, right? Because we were talking about this offline a couple of seconds ago. On the one hand, you think that, look, if the 10 goes to 5, may force the Fed's hand, they may have to U-turn and hike rates. Or if you take a look at what yields have actually been doing relative to the Fed, as the Fed has cut 100 basis points, yields have gone up 114, 115. Money has gotten tighter, so you could also argue that, look, it may allow the Fed to actually cut rates more aggressively or faster. Where does DB stand on this?
I think that's very important. You need to look at monetary conditions, right? Yeah. So what's the market telling you? And if you, as you rightly say, if you see yields going higher, that has implications on mortgages, which are a little bit longer term, on companies to refinance, obviously. So that could give some room for the Fed, though we are still in the camp. The Fed can maybe cut 2 times, 3 times this year, not more. Right. We're not in the camp of hiking. But that means you get a probably steeper yield curve, right? And that's a positive thing, for example, for financials, where we see quite a decent performance. By the way, also in Europe so far this year.
So steeper yield curve, but it's going to mean not bear steepening, which is what we've seen, but bear flattening.
Correct.
Led by the short end and central banks, the Fed.
That's exactly the view. Exactly, yes.
Okay.
So what do we do with this information, Christian? And with the Trump trade, is there going to be some reckoning, and is there going to be some unwind to the Trump premium in the US markets, which seem to be the default proposition right now? And where then does that leave how we allocate here in high growth Asia?
So I would say, as I said, right, you need to look at productivity growth. I think still the US is leading there. If it's going to higher yields, there could be some unwinding of the Trump trade. I think that's exactly the picture we have been seeing coming into 2025, right? You see yields going to 480. You see that unwinding of the Trump trade, no yields coming down, so you get back the Trump trade. I think that's exactly, we need to look at the bond side. Second area I want to mention then is Asia, where you see growth, and I think there could be some reallocation of money from the US, where there's everyone invested right now. I think it's the most overweight region at this point in time. And then if you keep looking at growth, that has to be Asia. Yeah, and unfortunately it's not Europe at this point in time, but I think if we see fiscal policy there, then people could also look into. So the rotation trade, I think, is a very important one to watch for this year as well. But so far, everything is still looking at the US.
Selectively, what parts of Asia? And India and Japan spring to mind. They are very popular overweights last year amongst global funds. Is that narrative going to ring true this year?
We still like Japan, for sure. But I would say don't write off China if they put in more fiscal policy. So I think that's not for now. But I think in the second half of the year, if you see some stabilization with tariffs, if we know where we are heading to, that could be, if there's more fiscal policy again, that could be interesting in China as well. So it's something we watch as well.